Step one is what we call observational analysis, and I'll show you how that works in a moment. Step number two is what we call backtesting signaling, and step number three is strategy execution, and step number four is then iteration in a forward testing environment. Those are the 4 steps. Don't worry, we'll go through them each one at a time. Now, where to begin? Well, the best way to do this with step number one, called observational analysis, is to explain it to you how we learned to trade. So when I started in 2011, it was simple. There was no textbook to trading. There was no educational course programs. These things didn't exist. All right? There was no charting packages like we have from Sierra Charts nowadays, where you could do all sorts of fancy bells and whistles and backtests. That just didn't exist back then. And if it did exist, it was extremely, extremely expensive. Okay? Now, how we learned to trade on day one is very simple. I sat with a group of 9 traders. Of the 9 of us, pretty much none of us knew anything about technical analysis. Okay, dojis and engulfing candles and all that stuff, we didn't know any of that. Okay, that just didn't really exist back then. So we had to do something called observational analysis. Now, we were taught market profile. So we were given a sort of a class on market profile and TPOs, and we were taught the baseline principles of market profiling and what this profile shape meant and what that profile shape meant. So we had a teacher who stood in front of us and said, if it looks like this, it means this. If it looks like that, it means that. Okay? Now, that was our learning. That's what we were taught. But that wasn't sufficient, because at the end of the day, that's just understanding baseline principles. So what we did, and what I did in particular, was I would go at the end of every single trading session and I would ask myself a simple question. Was there a directional move today that could be assigned to any logical reason? Okay, for example, if the market took out the previous day's high and then it just went up in a straight line, didn't pull back, just kept going up and up and up and up, I would then watch and observe daily highs and lows from that point forward. So every single day moving forward, I would get a line on the daily high and the daily low, and I would observe it, and I would try to interpret it. Okay? Now, you can all straight away say to me, well, yeah, but obviously it didn't work like that every day, which is true. Okay? Because guess what? What I found through observing this, through enough observations, was that 5% of the time when we took out a daily high or low, it continued in that direction. Only 5% of the time. So what did I have? Well, I had nothing more than just an observational statistic. But I had an understanding that a high or a low could be, in some context, important. So I captured that. Okay? Now, the next thing I would do is I would say, okay, let me now look at the high and low, but I'm going to attach a second variable to it. I'm going to call that variable volume because it's observant. I can right click on my chart and add volume, so I can observe what does volume do at the high and low. So I combined the two to form context. And what I observed was when there is a good strong break of a high and low, that typically continued, usually more often than not, so statistically relevant, it was above average high volume. So what I did was I started looking at highs and lows, and whenever there was high volume, I would capture that. I'd take a picture of the chart and I'd start capturing those. And what I found was that typically when there's above average volume and we break the daily high and low, that typically 20% of the time it would continue in that direction. So 1 in 5 times. Okay, do I have a trade strategy? No. I do, however, have an idea that volume combined with a break of a daily high and low gives me some form of observational contextual power. But let's be honest, the reality of making a 5-to-1, risk reward on this trade is extremely, extremely difficult. In other words, right now, all I have is some observational power. I don't have a trade strategy. I'm just observing and understanding the market. So I went a step further. And now to the equation, I added a third variable called absorption. In other words, when we break the daily high and low, and we have above average volume, and there happens to be absorption prior to the break, I found in this instance, 40% of the time, there was now a price directional move likely. Okay? Are you all starting to understand the purpose of what we call contextual observational analysis? In other words, we observe the market for what it is. We identify certain variables that we believe to have contextual power. And we take those variables and combine them to form what we call an observed pattern. Okay, we believe that high volume plus absorption plus the break of the daily highly low together gives us a potential trade strategy or trade idea. Okay, and that's step number one. It's called observational analysis or price bias or price directional observational analysis. Okay, now if I showed you my hard drive, very interesting, I've actually got hundreds of recordings of videos. Okay, we used to record our screens. Why? Because back then I couldn't put a footprint chart on because it didn't exist. Okay, so seeing absorption, I had to actually go watch it on a price ladder, and I used to watch the time and sales and see those 100 lots getting sold, and yet the price wasn't going lower. That's how we identified absorption. So I had to watch it on a price ladder and I had to record it. Now, why do you think I recorded? Because the reality is that the more times I could watch a video over and over, the more times I could pick up on different kinds of variables that I wanted to observe going forward. Okay. Now, obviously nowadays with obviously Sierra charts and the likes, and there's a couple of great platforms out there, you can do this all with very, very smart tools. Now note, I recommend that every trader follows step one, observational analysis. Why? It's very simple. When you look at trading through the lens of observational analysis, it forces you to think and interpret things in your own way. Not the way that Brannigan says, not the way that the textbook says. You are forced to interpret it for yourself and make up your own story behind why you believe it to be true. Moreover, I can tell you something is true as a variable. Okay, and I can tell you God's truth that 80% this is what it'll do. But the reality is you've got to be able and capable of interpreting and seeing that variable in real time. Okay, because you are the one that needs to be able to adopt that into your trading, not me. I've been through that iterative process of seeing that play over and over and over and over again. I don't need to make a believer of myself. I'm already a believer because I've done the hard work understanding and interpreting it. Okay, and we call that skill pattern recall, right? It's not something I can give you. It's something you have to adopt and learn for yourself through iteration. Okay, and finally, the third reason why I think you must do this first step is because you can apply this set of principles, this understanding of volume plus absorption plus a break of a high and daily low. You can apply that in different markets, but you can also apply it in different time frames. Okay, if you're a day trader, you apply it to a 1 minute chart. If you're a swing trader, you can apply it to a half an hour, 60-minute chart. If you're an investor, you can apply it to a daily chart. The principles stay exactly the same. But if you don't understand the principle in the first place, you don't understand how volume is influential because you've never observed it for yourself, the reality is you do not have that skill to be able to apply it in different markets and different time frames. Okay, that's step number one. Now, step number two is the backtesting signaling. Now, very often, a lot of you are probably going, oh, but surely you backtest first. No, you don't. And there's a very good reason for that. Okay. The reason I suggest you don't start with a backtest is because you will either be data mining or you'll be applying an idea that you heard online. Okay. But most importantly, you do not have contextual power in your backtest. In other words, you are trying to find a variable that's powerful as opposed to testing a variable you believe to be powerful. Okay, when you are trying to find a variable that's powerful, all you're doing is fitting the data. Okay, and you will find a variable that's powerful. Unfortunately, what you're actually doing is you're saying, hey, Mr. Dataset, show me what worked within this certain data set and give that to me. The reality is in the real world, when you try and apply that, it's going to fail. It's guaranteed to fail. Okay, we call that fitting. And that's why we don't start with a backtest. We start by identifying the variables that we believe to add contextual value or give us some form of a price directional bias. And price directional bias is nothing more than, if I see this, there's a high probability that the price is going to move in that direction, whether it's up or down. Okay, that's all price directional bias is. Now note, what we want from a backtest is very simple. Okay, backtest doesn't mean you need to do lots of coding. Backtest doesn't mean you're looking for 1,001 things. No, we want two things from a backtest. Okay, we want a high degree of confidence that when our variables or our context, okay, these three variables combined that I identified for you is called context. So when that context exists, what we want to know is, tell me if there's at least a greater than 50% chance of a price directional move. Now, price directional move doesn't mean 100 prices, it doesn't mean 10 prices. It just means that it goes in that direction. Okay, sometimes it's going to go a little and sometimes it's going to go a lot. That, at this point, is irrelevant. What's important is that price directional bias exists, and it exists at least 50% of the time. Now, what I want to know in terms of what I actually want to know from this backtest is two things. Number one is I want to know the directional predictability. In other words, expectancy. I want to know whether or not I can expect the market to move in my direction or not. And the second thing I want to know is frequency. Okay, how often is this trade going to be occurring? So what I would do is I would apply a signal. Okay, so I take this context called high relative volume, I add absorption, and I add a break of a daily high and low, and I say, Mr. Market, tell me with a nice sound or a dot or a cross or whatever, signal to me every single time this strategy appears on a 5-minute chart. And I can then very quickly go and say, now count for me in the last month how many times this has occurred. Because frequency combined with directional probability together are going to define the quality of the trade strategy. Okay, we need a trade to occur frequently, and we need a trade to have some sort of predictive probability in order for us to perform well and make money. Okay, that goes without saying. All right, so that's step 2. That's what you use backtesting for. Okay, this is not a traditional backtest where I put my stop there and I put my target there and I say, go find me, how much money I'm going to make. That game is best left to pure, sort of technical automated trade strategies. Okay, what we use a backtest for as discretionary traders is to understand price predictability and number 2, frequency. Those are the 2 key things we want to understand. Now, number 3, and this is where you can use a backtest a little bit further, but I'll caution you against it and I'll tell you why in a moment. So step number 3 is strategy execution. Now, you would have heard me say the following, which is that edge is found in the application of the strategy, and it's so true. Why? Many traders have got price directional bias. Okay, many traders. I know a lot of very good traders that have got a very good call on the market. They know when it's going to go up. They know when it's going down. They know when it's balancing. They know when it's rotating. They are fantastic at calling it. But the reality is price directional bias doesn't mean you have any edge. It just means you have a good idea. Okay, like I said, there are many traders I know that can call the market but make no money. And it's not because they're not good traders, it's because they do not understand strategy execution. It is step number 3 in developing a strategy. Now, my advice when you are developing strategy execution is just how you enter, where you place your stop, and where your target goes. Okay? My advice is keep it stupidly simple. Don't be too clever. You will never hear me use the word trailing stop. Why? Because trailing stop is one of the most complicated things you can do to any trade strategy. It's what the YouTubers came out, it sounded sexy of, oh no, you just put a trailing stop because it enables you to just continuously make money until the market pulls back. Okay? Don't get sucked into that rubbish. Trade execution is all about simplicity, and I'll show you a very interesting graphic in a moment that will explain to you exactly why you've got to keep it stupidly simple to be successful. Okay, now, entry price is defined simply by what we call the risk-reward skew. Now, I'm going to explain it to you briefly with this little image here. Risk-reward skew is nothing other than saying, if I get in where this red line is, my stop is, let's call it 1R. And if I get in at that point, and this is my target, it means I'm exposing myself to a potential 3-to-1 winner. That's what entry price skew is. Now, if I was to enter more in the middle of this sort of blue candle, let's call it, if I was to enter more in the middle, my skew suddenly starts to become more symmetrical. In other words, I'm risking as much as I'm potentially going to make. Now, there is no right and wrong risk-reward skew. Get it out of your head that you've got to make 2-to-1s and 3-to-1s. That's rubbish. Okay, what you have to do is you have to first and foremost understand the probability of outcomes. What's the likelihood that you are going to win on this trade? Okay, if you're 80% likely going to win, then you've got a very, very good trade opportunity. And if you only make a couple of ticks or you make less than you're risking, with an 80% likelihood of success, it's fine to have less than a 1-to-1 risk reward. Okay, so get it out of your head that there's a sort of a perfect rule of thumb as to the perfect risk reward. It's not got to do with perfect risk reward, rather what is your entry price skew. Okay, the next thing is stop price. A stop price goes where a trade is invalidated. Okay, and I'm not going to get too much into this because this is very intricate, but ultimately, if you are taking, for example, a breakout trade and you are trading momentum, the moment the market tells you momentum does not exist, you need to be out of that trade because the trade idea is invalidated. Okay, so we put stops where the trade is invalidated. And the third, then, the target is placed ultimately based off of objective strategy dependency. In other words, again, and I'm going to talk about this in topic number 3, we put a target dependent on the strategy we're taking. So for example, if I'm doing a breakout trade as a day trader, I'm going to exit when someone provides liquidity. Okay, I'm not going to exit looking for a 5-to-1 risk reward. I'm not going to exit, when it goes to the moon. I'm going to exit when the market shows me liquidity on the other side. Okay, it's an observational fact that I can observe with a tool. And I'll show you this in topic 3 so that you fully understand how we use targets and how we objectify our targets. Okay, so that's step number 3 is strategy execution. It's all about entry price, stop price, and target price. Now, within the Tradelo application, obviously a lot of the traders are familiar with this. What we use entry, stop, and price for is to develop our strategy at the end of the day. Okay, but equally with the use of smart data, we can start to get algorithms to tell us, for example, that we need to be aggressive on our strategies, that our typical target is 18 to 21 prices and it's a symmetrical target. Okay, so we can start to use data to inform what our targets look like, what our stops look like, and ultimately how we're entering trades. Okay, that is the power of data. I'm not going to go into this in too much. You can go to the Tradelo website and read up more about that. Okay, now, step number 4. This is where the real mastery comes, is what we call iteration or forward testing. Okay. Now, I was asked yesterday on a call, a trader actually said to me, tell me why traders can't import data into the Tradelo application. I said to him, it's very simple. Backtested data is hypothetical data. Okay. It's not ultimately what will happen in the real world. You can ultimately have a perfect strategy in a backtest environment. Okay. That doesn't mean it'll hold up in the real world. I also had another trader tell me the other day, they said to me, I've got a perfect strategy and it's got a 2-to-1 risk reward and it wins 80% of the time. And I didn't know whether to be mean to this trader or be honest with him. But the reality is it's meaningless to me because it doesn't account for the change which is guaranteed. If your backtest says you got 2-to-1, that means nothing. Because when you enter the real world environment, change is guaranteed. Everything is going to change. Sure, it might sound similar and it might look similar, but ultimately the results will always be different. Okay. Now, one of the things we use within the Tradelo application is what we call real risk reward. Now, how this differs from normal risk reward is normal risk reward says, well, hypothetically, I can make 2-to-1. Hypothetically, I can make 3-to-1. What real risk reward says is, what do you actually make? In other words, when you click the get out of that trade and when you actually take profits, how much reward did you make relative to your risk? Because that is a metric we can lean on. Okay, now what I will guarantee tell you is that I very rarely see a professional day trader that has got a real risk reward greater than 1 to 1.5 to 1. Okay, it just doesn't exist. Now, I know that's going to come as a shock to most of you because many of you have been, sort of ingrained in this idea that you need to make 2-to-1s and 3-to-1s and 5-to-1s. That's rubbish. Okay, and again, I'm going to show you an image in a minute that will explain why that is rubbish. Okay, ultimately, we look at the real risk reward. What do you actually take out of the market based off of how much you're risking in the market? We also then look at something called the effective win rate. So again, most traders look at a very baseline win rate called how often do I make more than $1? Now, the reality of a normal win rate is it's false. It's misleading. Why? Because at the end of the day, it's not going to cover my costs if I make $1 off a trade. It's not going to pay a wage and it's not going to help me grow a trading account. Okay. What is a powerful statistic is when we look at an effective win rate. What's an effective win rate? An effective win rate just simply says, if I risk $1,000, how often am I making more than $1,000 when I execute that trade strategy? In other words, it's looking at the likelihood or the win rate where you make more than 1-to-1 risk reward. That's powerful because that means if I'm making more than 1-to-1 risk reward over time, okay, and I've got a high win rate with that, it means I am actually making money as a trader. Okay, now, like I said to you, I've been around enough professional traders long enough to know that this idea of 2-to-1, 3-to-1 is very much marketing hype. It sells well. Guys, if I showed you a chart right now and I said, you just buy it here, and then you make 4-to-1, and your risk is so limited, it's so small, you're all going to buy into that. You're all going to have those heart palpitations where it just sounds so good, and you're like, I want that strategy. Right? The reality is that real traders are more fixated on understanding, one, where have they got price directional bias? In other words, in what structure or context is there a very high probability the price is going to go up or down? That's what real traders focus on. And the second thing they focus on is how can they enter and exit the trade optimally, where they can always minimize the risk. In other words, take as little loss as possible when they're wrong, but ultimately expose themselves to big winners when they're right. Okay, now, don't get me wrong, and this is crucial to stipulate at this point. There are times where I will take a 4-to-1, a 5-to-1, a 6-to-1. Okay? If you ask any of the Tradelo traders, in the oil this week, we've been quite active. There's been some really good 4-to-1, 5-to-1 trades. However, they are outliers. In other words, that's not normal. It's just the market has given us that opportunity scope this time around. But typically, over a series of 100 trades, you're maybe going to get 5 to 10 outliers. The other 90 trades, a lot of scratches, a lot of small winners, a lot of small losers, a couple of medium losers, and every now and again a big loser. Okay, that's more or less what a trader's sort of, trade curve would look like in terms of a distribution. Okay, so don't be misled by this idea of 2-to-1s, 3-to-1s, all that kind of thing. Okay, now, step 4 is ultimately where the mastery happens. This idea of iteration is where the mastery happens. What is iteration? It's simple. Remember in step 1 I said to you, you observe the market and you understand the context. Step 2 I said you now go and backtest it to determine if you have price directional bias and frequency. Step 3 I then said you need to go and develop an idea of entry, stop, and targets. Now step 4 is the iteration part, which is every single time this context exists, I go capture that chart, I go capture that opportunity, I go capture how I entered it, where I placed the stop, and where I targeted. And what I do now is I just stick with a very simplistic approach to it, and every single time I see that context, I try and interpret, could I have tightened my stop, or did I need a slightly bigger stop that could have kept me in the trade longer or ultimately got me out of the trade sooner? Could I have maybe taken a few more ticks if I consider exiting because of a different observational objective parameter? Could I have entered more aggressively or passively that would have allowed me to have a slightly different risk reward skew and more asymmetry in the opportunity? Those are the key factors when it comes to iteration. That's what we're trying to do. We're trying to find through iteration how we can improve on our ultimate execution of this trade idea. You do this 20 times, you do it 30 times, you do it 100 times, and you become pretty damn good at it.